Microsoft and Google reported their most recent quarterly earnings this week, and we are going to do a deep dive by looking at their financial statements, and we'll be looking at why Microsoft stock reacted positively to these earnings and why Google stock actually reacted negatively to these earnings. So if that's some content you'd be interested in listening to, I encourage you to watch this video and give it a thumbs up if you like the content. So without further ado, let's go and dive right into the video. So Microsoft stock has been up about 5.65% over the past month. Over the past 6 months, it's up about 8.19%, and year to date, it's up about 37.66%. Let's go and look at their most recent quarterly earnings. So as we can see here, Microsoft Cloud strength fueled their first quarter results. And as we can see, their revenue was about 56.5 billion, which increased about 13% from the same period of the last fiscal year. If we look at the operating income, that was about 27 billion, increased 25%. Net income was around 22.3 billion, that increased 27%, and diluted earnings per share or EPS was $2.99, which increased a whopping 27%. So these are huge, huge growth numbers for the already large tech giant or software company, Microsoft. Here we have some comments from Satya Nadella, their chairman and CEO. He said, with co-pilots, they're making the age of artificial intelligence real for people and businesses everywhere. They're rapidly infusing AI across every layer of the tech stack and for every role and business process to further drive productivity gains for their customers. Let's go and look at some of these business highlights. So their revenue in productivity and business processes was 18.6 billion and increased about 13%. Their revenue in intelligent cloud here was 24.3 billion and increased 19%. Now, one thing I want to draw to your attention is in this cloud business, their server products and cloud services revenue increased 21%, driven by Azure, and other cloud services revenue grew at a whopping 29%. So this was the highlight of this earnings call and also the highlight of their quarterly financial statements or their earnings. So again, this was huge, huge growth. It reaccelerated. The cloud was seen as kind of slowing down for Microsoft, and now it has actually picked back up. So a great, great cloud services revenue growth percentage increase here, in my opinion. Let's go and scroll down. Let's go and look at the actual growth in terms of percentages. So here we can see the percentages in constant currency and the percentage change based on GAAP. So we'll look at the constant currency here because it's all in this table. Now, Microsoft Cloud, 23% growth. Microsoft Office commercial products and cloud services, 14% growth. Office 365 at 17% growth. Office consumer products, 4%. LinkedIn at 8%. Dynamic products and cloud services at 21%. Dynamics 365 at 26%. And again, here, Azure and other cloud services at 28%. So the majority of this already large market capitalization blue chip company has been growing at such high growth rates. And this is very, very great in my opinion. It's very hard for companies when they reach this size to grow this fast. So again, these are just great growth percentages here in my opinion. Let's go and look at their financial statements. All right, so we can see the income statement. So 2023, this latest quarter for September 30th, 2023 ended compared to the same quarter in the previous fiscal year for September 30th, 2022. So we can see product revenue stayed basically flat, but then this services and other revenue, which includes cloud, did have reacceleration in growth, resulting in total revenue of 56.5 billion compared to that 50.1 billion. So again, an increase of about 5.4 billion here in total revenue. Now, revenue is not the end all and be all. We're going to be looking at their margins and net income. So along with this revenue here, the costs associated with generating that revenue, it actually only ticked up a very like 800 million. So like for this additional $5.4 billion of revenue, they only had to spend another $800 million. And that speaks to the strength of the cloud here. Those cloud margins in that cloud business are 70%. They're near 70% in terms of their gross margin. So again, super scalable and profitable business here. And the gross margins or the margins on these products or these services that they provide are great. Now, the gross margin here at 40.215 billion, again an increase of roughly 5.4 to $6 billion here. And now let's look at their costs here. So this right here, great cost discipline by Microsoft. Their costs are generally flat here. That's 6.6 billion to 6.6 billion in research and development. Sales and marketing is relatively the same, and general and admin, again, generally the same. So great cost discipline. They've kept their costs in line with the same quarter last year while increasing their revenue. So great job here by management. This results in operating income of almost 27 billion compared to 21.5 billion in the previous quarter of last year. And then once you take income taxes into effect, their net income roughly 22.3 billion compared to 17.5 billion for the same quarter in the previous year. Now, when you look at the earnings per share, $2.99 on a diluted basis compared to $2.35 in the previous year. So great growth for such a large software giant already. We're going to scroll down and look at their balance sheet. All right, so the balance sheet here, assets. Now again, they're split between cash and cash equivalents and short-term investments. You could look at this as just their total cash pile here. So they've got $143 billion. It's a lot of money. It's unfathomable to me, that amount of money. But again, these are large multi-billion-dollar corporations. So Microsoft having almost $144 billion of cash. They've got some accounts receivables, total current assets of $207 billion. And they also have some property, plant, and equipment here, making up the majority of their other long-term assets. Now, if we scroll down and look at their liabilities, there really aren't that many when you compare them to the assets of the actual company. Now, what I always like to point out here or look at in terms of their liabilities is their debt. So they have there's usually a current portion of long-term debt, and there's also short-term debt as well as the actual long-term portion of that long-term debt. So when we add these together, we can see about roughly $42 billion of long-term debt, and short-term debt and the current portion of the long-term debt here, roughly about 30 billion. So they've got about $70 billion here of total debt. And when you compare that to the actual cash pile of $143 billion, they can pay off this debt no problem. Again, it's just crazy. This amount of money that they generate from their business while taking on such very little debt is astounding to me. So a very healthy balance sheet here, in my opinion. Now, we're going to go and scroll down and look at the cash flow statements. So the cash flow here, again, you drop down your net income, you adjust for those non-cash items such as depreciation, stock-based compensation, and you also have some income taxes here as well. And then you adjust for your changes in your balance sheet, resulting in about $30.5 billion of net cash just from the operations side. So strong cash generation here in the quarter, printing roughly $30 billion of cash from operations. Now, when you take financing and investing into account, so again, financing here, this is where you put in any of your common stock that's repurchased, any stock that you issue, you have any repayments of debt, and then any maturities of debt, you would add that in here as well. And then investing into their business, or CapEx, is in this section, in property, plant, and equipment, any investments that you purchase or any investments that mature, resulting in net cash for this quarter of $45 billion. So again, these are the different categories of the cash flow statement, and I like to look at this operation side here first, just to see what the business actually generates in cash in terms of operationally. So again, super strong balance sheet, great results here from Microsoft, and we need to be aware of one thing. So they actually did get approval to buy Activision Blizzard for roughly we'll call it $70 billion in an all-cash deal. So when we look at the balance sheet, again, we had about $70 billion of total debt here, and we have about $70 billion of committed cash for this Activision Blizzard deal. So even if they spent all of their cash on paying off the debt and going through with the deal, they would still be able to do so with having a little bit of cash left on hand. Again, roughly $4 billion. They will not do that, obviously. They will not be paying all the debt off and fronting the cash for the Activision Blizzard deal. They will be keeping that debt on the balance sheet, but again, just great to see in terms of if they had to do both, they had the ability to do both. They will not, but it's just crazy to think about how much cash they have. And again, when you're generating $30 billion of cash here just from your operations, they'll be able to recoup this cash from this Activision Blizzard deal within the next 2 to 3 quarters. So again, this deal, in my opinion, is only going to be accretive or beneficial to us long-term shareholders. So that was the financial statement review of Microsoft's latest quarterly results. Now we're going to go and jump into Google. So Google stock over the past month is down about 5.73%. Over the past 6 months, it's up about 13.55%. And year to date is up about 37.08%. Let's go and look at their quarterly results. So their CEO, Sundar Pichai, said he's pleased with their financial results and their product momentum this quarter with artificial intelligence-driven innovations across search, YouTube, cloud, Pixel devices, and more. They're continuing to focus on AI to be helpful for everyone, and there's exciting progress to come. So let's look at their revenues here. I really like Google's the way they present their financial statements. Super simple and easy to read. So we're looking at the quarter ended most recently for September 30th, 2023, compared to that same quarter in the prior year of 2022. So revenues last year were 69 billion compared to this year for that quarter, almost 60 or 76 billion. So again, 76 billion compared to 69 billion. Great changes in revenue, resulting in 11% increase of revenue over that year. Now look at the operating income, 21.3 billion compared to 17.1 billion. Great growth here. So again, a $4 billion jump here in operating income. And we're talking about tech giants. These are not small growth companies. So to see this growth here is amazing in my opinion. Now the operating margin, it actually expanded from 25% to 28%. So they found some efficiencies here in their operating systems when generating this more revenue or a higher percentage of revenue, again, resulting in operating margin expansion of 3%. And when we look at the diluted earnings per share, a whopping jump here from 1.06 diluted EPS to 1.55. So great snippet here of their income statement and their net income as well as their EPS. So let's go and look at their statement of income. So as we can see here, for each of the quarters, we'll be looking at 2023 compared to 2022. And if you wanted to look year to date, that information is here as well. But again, that revenue jumping up that $7 billion for year over year. And then the cost of those revenues. So again, the costs, they actually had very disciplined cost management. Again, a lot of people calling this the past year of efficiency, where these tech giants focused on controlling their costs and expanding their margins. So again, very nice cost discipline here. And this resulted to income from operations of an increase of roughly $4 billion. And when you account for income taxes, again, net income here expanding from $13.9 billion for the previous year to roughly $19.7 billion. So a nice increase there of $6 billion. So great growth here from Google in my opinion. And that takes you down to your diluted earnings per share or EPS of $1.55. So let's go and look at the balance sheet of Google. So again, as we can see here, it's just crazy to think about, but $119 billion of cash and cash equivalents, including marketable securities. So again, a huge cash pile. Like, this company is sitting on a mountain of cash. I can't even imagine all of this money sitting in a couple checking accounts or a couple marketable security accounts. Like, it's just unfathomable to me. But there it is, $120 billion of cash. And when you add in a couple of their other assets, you get $176 billion worth of assets and their PP&E or property, plant, and equipment as well. Now, when we look at their liabilities in a similar fashion as we did to Microsoft, they actually have a lot less in terms of debt. They have $14 billion of debt. That's it. $14 billion of debt. Again, sitting here all in the long-term debt pile. So for them, this is a drop in the bucket. They could pay this off. They wouldn't even notice that they paid it off. Again, just a crazy amount of cash here compared to their total debt. I love to see that. A very strong balance sheet here, in my opinion. Let's go and look at their cash flow statement. All right, we're looking at the quarter. So again, your net income drops down here. You add back any depreciation or non-cash expenses such as stock-based compensation, depreciation, income taxes, etc. And then you add for your changes in your balance sheet items, resulting in $30 billion of cash from their operating activities, very similar to Microsoft as we previously looked at. Then you take into account their investing activities, again, purchasing any PP&E, purchases of any securities, any maturities of securities, etc. Investing activities here resulting in a decrease of cash of $7 billion. And then their financing activities, which they include here, which include repurchases of stock, again, and repayments of debt. So again, they're buying back their shares. This is great to see from Google. They traditionally have not done this. They've usually just issued stock-based compensation, but they've started to do this over the past year or year and a half. And again, as we can see here, $15.7 billion of stock being purchased and canceled. Now, one thing that we do need to think about here is that as they are buying this back, please also remember that they also do issue stock. So when they do issue stock, as we saw as a stock compensation expense, so again, it does kind of negate to a little effect the power of these stock purchases and cancellations. If they're buying back $16 billion of stock, but they're also issuing back $5.7 billion of stock to their employees or their executives, it's really about $11 billion of stock that they bought back. But again, nevertheless, they are buying back stock and canceling it, so that's great to see as a shareholder. All right, so here we have the segmented results, and we're going to be talking about, again, speaking to at the beginning of the video, why I mentioned that I believe Google stock actually did fall, even though these results were super great compared to Microsoft, which actually rose their stock price. So as we can see, Google services knocked it out of the park. Great revenue here. Google Cloud accelerating revenue growth. Very, very nice to see. And there are other bets, which they don't really disclose what they are. Again, it's basically just a drop in the bucket here. Very, very immaterial here to Google's operations. Now, their operating income for each of these segments, $23 billion from Google services. This is the majority of that income from operations. Google Cloud actually turned positive in terms of operating income. So it's generating operating income as opposed to losing money previously in the past. And there are other bets, again, just spending money here. But what really caused the stock price of Google to fall when they released these results, in my opinion, was the cloud growth. So this is great, turned positive. They're generating positive operating income. But when you're comparing that to Microsoft, the growth rates are slower. So this change in terms of their revenue generation and their actual operating income, this was at about a 22% rate. When you compare that previously to Microsoft was a 29% rate of growth. So as Google is smaller in the cloud space, again, they're the third player behind Azure and AWS. So again, that's Amazon's AWS and Microsoft's Azure cloud systems. Google Cloud is actually the third largest player here. So what most investors probably would be thinking is if you are a smaller company in this space, you should be growing at a higher rate or a higher percentage rate, which Google did not do. So this was seen as negatively affecting their stock. So if we can see their past 5-day performance, right after they released the results, their stock did decrease significantly from about $140 per share down to about $127 per share, and again has been sliding this whole week. Now, when we compare that to Microsoft, after their release, their stock jumped from $330 up to $345. So again, there was a big difference in the stock reaction by investors or the stock price reaction. Now, do I think that Google had horrible results? No, these were amazing results in my opinion. I thought they were great. Again, this cloud percentage increase, it's still a profitable business. And again, when you look at that operating income of 266 million compared to the 24 billion that they generate in terms of their services, this is a very, very small business. It's going to keep growing. It's a very high margin business. It's just that it's not their main business yet. And again, all of this is going to be accretive or beneficial to shareholders of Google. It's just going to take some time. Just being third in that space does not mean that your business is valued less. You are being third in a very high margin business and is going to continually grow over time. Again, they probably won't catch up to AWS or Azure, but it will still be a very profitable business and accretive to the shareholders of Google. So I thought it was an overreaction. And what did I do? I bought some Google. So Google, I bought about 1% and added it to my portfolio here in terms of dollar value. Again, this is a holding. I wanted to take advantage of that stock price drop and start adding it or dollar cost averaging into my portfolio here. So I took that weakness as a sign and I bought some Google. Again, I plan to build it out to roughly a 4% position if I can over time. And I just started to DCA or dollar cost average into this position on weakness. I think it's gonna be great. It's gonna grow at a very, very high rate. It just might not be as high or take as much market share as Microsoft or Amazon. But again, I still think it's a great, great business here. Sitting on a ton of cash, very little debt, great, great business. Properties, YouTube, Google search, again with the cloud, great, great growth trajectories here in my opinion in terms of AI as well. Now, Microsoft is still my largest holding. As you can see, I'm about 25% here, and I'm going to keep my Microsoft position. I am not selling any of this position. Currently not adding to it. It's still decently, fairly valued, I guess. Maybe perhaps a little bit overvalued, but I'm going to just hold on to my position, not selling or buying at these prices. So that was the breakdown of the most recent quarterly results of Microsoft and Google. And if you had any comments or questions, I encourage you to leave them in the comment section below. And with that, I will see you in the next video. Have a great day. Bye. Please note, I am not a financial advisor by any means. All this content was merely for your entertainment purposes only. Please do your own due diligence when investing, as I am not liable for any investing decisions or losses you may incur. Thank you. Bye.